Thanks so much, Ray, for the very kind introduction. And also, thank you for your insights into what's going on in the mortgage industry and the home buying and home selling markets. Um, wow, it is a very interesting time to say the least. Clearly, it is a very dynamic and exciting time, which is probably why we have so many attendees today. So, wow, it is great to have so many people joining us. Thank you for being here today. And also, it's great to see that so many of you who are attending are looking to purchase a home. Obviously, that's what we're here for today. Again, my name is Chip Allen. I will be your presenter for the first session of our symposium today. And we are going to be reviewing tips for purchasing a property in the U.S. Before we get started, I want to give you just a quick summary of what we're going to be reviewing so you sort of know what to be looking forward to. We're going to review the different property types that are available for purchase or for home ownership in the United States and how you occupy that property. And then most importantly, how the property type and your occupancy impacts your eligibility for a mortgage loan, or how you go about financing that particular property. I'll give you a very high-level overview of the home buying process, really from the very beginning steps all the way to the closing of the purchase, the completion of this exercise. I'm going to place some special emphasis on the importance of a mortgage pre-approval. I cannot overemphasize how important it is in today's highly competitive market, just as Ray was talking about. We'll touch on some of the most commonly used terms in the mortgage process. Listen, this is a language that you don't speak every day, nor does anyone who's not in the home buying process. So some of these basic terms I want you to become familiar with so that you don't feel daunted by terms that are being thrown out by all the various parties involved in this process. And finally, we're going to touch on how UNFCU is specifically tailored to help you in this home buying process. Look, our goal is to make this as frictionless and as straightforward and as easily understood as possible. It's a long and somewhat confusing process, so we are here to walk you through that. We're also going to touch on a couple of brand new items that are available that are designed to, some new programs that are designed to make the home buying process even more flexible and easily navigated than ever before. Okay, so let's move on to our next slide. So we're going to touch on three different types of home ownership. We will review 1 to 4 family houses, condominiums, which are also called condos, and cooperative apartments or co-ops. Next slide, please. So the most common type of home purchase is for a single family residence. This is the house that you see, in a TV movie. It's a house with a yard and a tree and a driveway. It would typically be a single family residence. You own the house and you own the land that it sits on, whether that is a comparatively small quarter-acre lot or if it's several acres out in the country, but you own the property, the house, and the land. Since you own this real property, it gives you a lot of freedoms in how you use the home. You can make additions to a single family residence at any time. You own it. So if you want to add a bathroom or a deck or a pool, you're welcome to do that whenever you choose to. You can make alterations if you want to expand your kitchen, or if you want to put in skylights or solar panels. All of those options are available for you. You can sell your home at any time to anyone that you'd like. You can also rent it to anyone that you'd ever like to. I know that sounds sort of self-evident, but you'll see as we review some of these other property types how that is not always the case. So when you own your house, you can sell it at any time. If you have a mortgage, your mortgage would be paid off and you would move on to your next home owning adventure. With all of this freedom that goes along with the ownership of a single family residence, there are also some different responsibilities or some greater responsibilities. You own this home. So maintenance of this property is fully up to you. So if there is the need for a new furnace, or if the roof needs repairs, or if the stairs are broken, it will be incumbent on you to make those repairs. There will not be any type of third party to intercede on your behalf. So maintenance for a single family residence is fully yours. Additionally, you will owe property taxes when you own real estate in the United States. This is a question that comes up frequently for our UN staff members or G4 visa holders who do not pay, unless you're a US citizen or a permanent resident, don't pay US income taxes. And that remains true. Property taxes or real estate taxes, however, are different. Property taxes are the taxes that you pay to the municipality. So that's the city or the town or the county for the services that the municipality provides. And that usually includes fire department or police protection, schools, road repairs, plowing the roads during the winter. All of these are services provided by the municipality, and you pay taxes as a property owner, regardless of your immigration or visa status. You pay property taxes. Now, you can see on this slide that we have noted 1 to 4 family houses. The single family residence is very straightforward. It's just a house, single family house. But the credit union also offers mortgage loans on 2 to 4 family properties. You can see in the picture here on this slide, that looks to me like a 2 or maybe 3 family home in Brooklyn where I used to live. So with a multifamily property, there are a lot of advantages to a multifamily. You buy the home as a primary residence and you occupy one of the units. The other units are then available for you to rent out to a tenant. So obviously there's some really nice income potential when you own a multifamily property. There are some drawbacks. I mentioned the responsibilities that you have as a homeowner for all of the repairs. It's a bit of a double-edged sword when you have become a landlord, because on a multifamily property, when you live in one unit and rent out the others, you are effectively a landlord, and your tenants may have even more demands on their repair or maintenance needs than you would personally. So there's a lot of opportunity in buying multifamily properties. There's quite a bit of work involved. Personally, I would not recommend buying a multifamily property as your very first home, but it's always an option, something that you would want to educate yourself on very, very fully. Quick side note. I've noted that we and the credit union makes mortgage loans on 1 to 4 family properties. If you were interested in a home that had, say, 6 units, that property in the real estate industry is considered a commercial property, which means that the types of residential mortgages that we make at UNFCU would not be available. You would have to take out a commercial mortgage, which is a completely different type of loan to buy a residential property that has 5 or more units. So just keep that in the back of your mind, that for residential mortgage lending, what we do here at UNFCU, you can consider 1 to 4 family properties or houses. Okay, let's go to the next slide, and we are going to move on to condominiums, frequently called condos. So condominiums could come in the form of a high-rise condominium in New York or Philadelphia or Los Angeles, wherever. Or it could be in a more suburban or garden-style condominium, maybe like the picture that we see here, where the condominium project could be built around a swimming pool and tennis courts and so forth. Whatever the type of condominium that it is, they function in the same way, which means that you own the physical apartment. So it's similar to a house in that way. You own the interior of the condominium unit. The difference is that the exterior of the property is maintained and managed by the condominium association. So when you own a condominium, you can almost think of it as a shoebox in the sky. You own the inside of that property, and the exterior is owned really by your condominium association. What that means, though, is that for the interior of your condominium, you can make alterations. Certainly, if you wanted to expand your kitchen or add a bathroom or a powder room, it might be difficult to make additions to the exterior, but you could add on the interior of the unit, say add a bathroom. You typically would not be able to make any changes to the exterior of the property because the exterior of the condominium is maintained and managed by the condominium association. As with a house, when you own a condominium, you can sell to anyone that you'd like. In the vast majority of cases, you can rent out a condominium. So that's of particular importance for UN staff members and their mobility issues. So let's say you own a condominium in New Jersey, and you are going to be going to Nairobi for 2 years as your new duty station, and you'd like to rent out your condominium while you're away. You'd want to check with your particular condominium, but the vast majority of them would allow you to do just that. So there's quite a bit of flexibility in the ownership of a condominium. You are responsible for the maintenance of the interior of the unit. So if you have a leaky toilet or a broken stove or a fire on the interior, you are responsible for those types of repairs. The condominium association manages the outside. So you pay a common charge each month to the condominium association. And that is for their upkeep of the shared common areas for this condominium. So that could be that swimming pool or tennis court that I mentioned. It could mean mowing the grass during the summer or plowing the parking lot and shoveling the driveways during the winter. It could mean expenses for maintaining the elevators, rooftop gardens, and so forth. So on that single family or multifamily property, you are specifically responsible for all maintenance. On a condominium, some of the maintenance is going to be managed by the condominium association. The amount of your common charge can vary a lot depending on the condominium. So if you're buying a $1 million condominium in Manhattan that has a rooftop pool and basketball courts and a restaurant in the lobby, your common charges might be quite high because the common charges are paying your prorated shares of the upkeep of this building. And that's an expensive building with expensive amenities. So your common charges could be comparatively high. Alternatively, if you were to buy say a condominium in a garden style property with a fairly small number of units, the common charges could be quite low because the association may not really do very much periodic cleaning of the exterior, mowing, plowing, and etc. Something to keep in mind. The amount of the common charge will certainly vary depending on, well, where the property is and the type of condominium that you're buying. Same as with the house. You owe property taxes to your municipality when you own a condominium. Again, you own real property, so you owe property taxes for the services that you receive in your municipality. Let's go into the next slide, please, which is a co-op or a cooperative apartment. Co-ops are rather unique, but they are very, very common in the New York market. About 65% of the owned apartments in New York City are co-ops. So it's very, very relevant for our members who plan to buy, in or around the UN headquarters. If you are planning to purchase anywhere else in the United States, you almost never will run into a co-op. There could be a handful of them in, say, Washington, D.C. or Boston, but really you could count them on two hands. So not many co-ops exist outside of New York City. But it's important that we talk about them because they're so common. The credit union does a huge amount of co-op lending because of course, UN staff members being based in New York. So how does a co-op work? A co-op is different in that the building itself has become a corporation. For any of you who, of course, familiar with UN headquarters on First Avenue in Midtown Manhattan, across the street, there is a development. There are sort of high-rise brick buildings called Tudor City. Tudor City is made up of co-op buildings. So each of those different buildings is a co-op. Each of those buildings has become its own corporation. The corporation doesn't sell units as with a condominium, because remember, when you buy a condominium, you own that physical space. Instead, with a co-op, the cooperative corporation sells off shares in the corporation, almost in the same way that you would buy shares in IBM or Coca-Cola. So you buy shares in the corporation, and ownership of the shares gives you the right to occupy the apartment. You don't technically own the apartment. Instead, you have a long-term lease called a proprietary lease. And it lets you live in this apartment for many, many years. It doesn't run out, so you don't have to worry about that part of it. So you own this stock in the corporation, and you have this long-term lease, and now you can occupy the apartment. Let's go to the next slide, please, because that's talking about what the cooperative corporation does. Let's talk about how it works for you as a co-op owner, and we're putting that in quotation marks because technically you're a lessor. But you don't have title to the apartment. You're effectively leasing it from the cooperative corporation. In co-ops, there are a lot of rules. There's a board of directors of the co-op corporation. And in order for you to make any types of changes, you would have to have approval from your co-op board. In some cases, that could even mean painting. It certainly means if you want to make an alteration or say an upgrade to a bathroom or to a kitchen, change out the flooring, or any of the room dimensions, that would require planning and approval with your co-op board. This is where it's coming into play about being able to sell or rent your home to anyone that you like. So I'm going to back up for just a minute. When you buy a co-op, not only do you need to go through an approval process to obtain a mortgage loan, but you also need to be approved by the co-op's board of directors, which means that you will need to submit an application, which includes your financials, your assets, your credit. It will require like personal letters of introduction from friends or colleagues or coworkers. You would go through an interview process. And believe me, they've continued right through COVID. So either they're in person or they're virtual, but you go through an approval process with your co-op. And hopefully, if you're choosing to buy a co-op, you will fly through that board approval process with flying colors. It's an involved process, and you would need assistance from your real estate agent. We'll talk about that in just a bit. So let's say you've bought your apartment now, or at least the shares in the co-op corporation. Most co-ops will not allow you to rent out the apartment. And that's just the hard truth of how co-ops work. They have a lot of rules. There are some that will allow rentals, but the vast majority do not, which is, of course, a big concern for you and staff people. Because again, if you are going away on a long-term mission and your co-op building does not allow rentals or sublets, that means it's going to sit there empty, and you are going to continue to make your maintenance payments to the building and your mortgage payments while you have no tenant. So it's something certainly to keep in mind. Someone with a lot of mobility concerns may want to tend more toward a condominium or house as opposed to a co-op. Also keep in mind that while you have to go through the board approval process in order to buy this apartment, when you're ready to sell it, your buyer will have to do the same thing. And unfortunately, if you ran into a situation where the buyer, your buyer, did not get approved by the co-op's board of directors, then you could not sell the apartment to them. That sale would be voided, and you would have to start over and find a new buyer. So there are certainly concerns, or at least items that you need to be fully educated on when you are considering the purchase of a co-op. I mentioned that you do have a maintenance fee payable to a co-op, similar to the common charge. on a condominium because it is paying your prorated share of the upkeep of this co-op property. That maintenance fee also includes your portion of the co-op corporation's property taxes. So when you own a co-op, you ultimately own shares in a corporation and not real property. You do not personally pay property taxes. However, the corporation that owns the building does owe taxes, and you would pay your portion of the corporation's taxes as part of your maintenance payment. The long and the short of the co-op is you want to be very educated about the process when you are looking to purchase one. Okay, let's go to the next slide. We've talked about these different types of properties. Let's talk about how you own them, and you'll see why this is important. You can own a property as a primary residence. My assumption is that the majority of you are probably our first-time home buyers, and that the majority of you would be purchasing a primary residence. That's the house that you live in, or the home, the apartment. It's where you live, where you go home and go to sleep at night. So primary residence carries the greatest amount of flexibility in terms of financing options. I'll come back to that in just a minute. The credit union also offers mortgages on second homes, or vacation homes. So let's say you live in New York, but you would like to purchase a weekend home in the Catskills north of New York City, or a home in Florida. Or as Ray mentioned, we lend in all 50 states. Maybe you're a lucky person and you're going to buy a condominium on the beach in Hawaii. But a second home or a vacation home is designed for use by your family, you and your family, and not for rental. It's not the home that you live in all the time, but it's the home that you would live in at a portion of the year. And finally, the credit union also offers mortgage loans on investment properties. So investment properties are homes that are purchased specifically for rental. So you do not intend to occupy an investment property. You're buying it so that you can rent it out and enjoy that investment income. We do a lot of investment property loans at UNFCU. UN staff members typically are not or do not have the opportunity to be employed outside of the UN. However, investment properties are allowed, are available. So we do a lot of lending for investment properties. The difference between each of these types of occupancy really comes down to the down payment. And that's one of the commonly used terms that we're going to go into a bit more detail about in just a moment. But let me say this, the down payment is the portion of the purchase price that you're paying out of your own funds. The amount of down payment that's required could be as little as 5% or as much as 30%. And there's a lot of factors that go into play, but occupancy is one of the main factors. The least amount of down payment is required for a primary residence. As a lender, and from the lender's perspective, we see a loan on a primary residence as the least risky. And statistical data over many, many years shows just that default rates on primary residences are very low. And listen, no lender plans on having defaults or foreclosures. That's the last thing that we ever want to have happen, but we do have to plan for it. Primary residences have the lowest default rates. And I would say credit unions in general have some of the lowest default rates for US financial institutions. And thank you very much. UNFCU's default or collection rates are incredibly low. So our members are very, very conscientious about making their payments, which allows us to lend on a primary residence with a minimal down payment. A second home probably would require a down payment of say 10 to 20%. Doesn't sound like so much, but let's say you're buying a $500,000 property. A 10% down payment is $50,000 and a 20% down payment is $100,000. So we're talking real money. Those percentages add up very quickly. On an investment property, The down payment would be maxed. So you probably would be looking, or not probably, you would be looking at a minimum of 20% down payment and potentially up to 30% down payment, depending on some of these other factors. Okay, so we've touched on the property types, how you own them. Let's keep moving. So if we could go to our next slide, please. We're going to look at this high-level overview of the home buying process. So next slide, please. The very first step that you will take in this process. Number one, you will want to schedule an appointment and meet and speak with a mortgage representative at UNFCU. Ultimately, you'll want to create a team. That's going to be your mortgage representative. So you choose your mortgage lender, and look, we better hope that that's going to be UNFCU. You're also going to want to choose a real estate agent. A lot of members ask, there's so much information available online now. Do you really need to have a real estate agent in the process? My answer is a resounding yes. You're going to hear from our good friend Lisa, who is a really fantastic real estate agent, later on during the symposium. And I think once you hear her speak, you'll really understand the importance of having a professional, experienced real estate agent on your side throughout the process. Listen, buying real estate anywhere in the United States is complicated, let's be honest. It's even more so in New York. As with everything, things are more complicated in New York. So it's really important to have a good real estate agent working with you and with your mortgage team. You'll also need to choose a real estate attorney. In the Northeast of the United States, a real estate attorney is required for you as the buyer and also for the seller. And we as the lender would have an attorney. So in New York, there can be 3 or maybe even 4 attorneys involved in the process. My good friend and a long-term colleague, Chris, is going to speak toward the end of the symposium and help you understand the role of the real estate attorney, how important it is to have all of these legal matters ironed out and clear from the beginning, because the last thing you want to do is purchase a home that ends up having legal or title issues. We'll go into those details. But you're going to create a team. In this ideal world, you'd be choosing a mortgage representative from the credit union, a local real estate agent, and a real estate attorney. When you meet with your mortgage representative in your very first meeting, you will do what's called a mortgage pre-qualification. A pre-qualification is a very preliminary step. It's your first meeting. In that meeting, you will tell your mortgage representative about your income, how much you have in the way of funds to use toward this purchase, what you'd like to buy, meaning an apartment in the city, a condo on the beach, a house in the suburbs. And your mortgage representative will be able to do a very detailed calculation for you. And it's done in a matter of minutes. But it's really highly accurate. Your mortgage representative will pre-qualify you and let you know the amount that you're qualified for in terms of borrowing. And let's be honest, when you first start, you may not know, do you qualify for a $200,000 mortgage or $1 million mortgage? And you don't want to be wrong in either direction. So it's very important to have that initial meeting and be pre-qualified for your mortgage. Some lenders use the terms pre-qualified or pre-qualification and pre-approval interchangeably. For us, there are actually 2 distinct steps. The pre-qualification, again, is done very, very quickly. Hey, as a very quick side note, just take this in your notes. You will qualify for a mortgage loan that's equal to approximately 4 times your gross annual income. I know that sounds sort of crazy, but it does work. I've been doing this for a lot of years. And really, if your gross annual income is $100,000, you should qualify for a mortgage loan of around $400,000. Just keep that in the back of your mind. So we've talked, that's the pre-qualification. A pre-approval is a more formal step in this process. Let's go to the next slide, please, because we're going to talk more about pre-approvals. So with a mortgage pre-approval, let's say you've already done some research online, you have a good idea, you want to buy a single family residence in Connecticut, and you have an idea of, you've been pre-qualified, you have an idea of what it is you'd like to buy. And now you'd really like to get serious. You'd like to start going to open houses, working with your real estate agent, and ultimately make an offer. You really need to become pre-approved. So with a pre-approval, you would submit a mortgage application. We will document your income, your assets, your credit report. And we're going to talk about credit a bit more in depth later in this presentation. But we'll review all of your personal qualifications for a loan. We're going to fully underwrite your loan. That means that all of your supporting documents and the parameters of what you assume that you would like to buy are going to be reviewed by one of our mortgage underwriters. That's someone who works for the credit union. And these are the people who actually review and approve or decline loans. So your loan will be fully pre-approved. We will issue to you a concrete formal pre-approval letter that says to a real estate agent, to a seller, other attorneys, anyone else involved, that pre-approval letter will say that you have been approved for your mortgage, and that as long as you find a qualified property, an approvable property, then you can get your financing. As Ray mentioned, it is, and as Lisa's going to also discuss, I'm sure, it is an incredibly competitive real estate market throughout the United States. A real estate agent and a seller really are not going to want to spend their time working with someone who is not pre-approved. And I understand it from their perspective. Why basically waste time on discussing a sale to someone who may not be able to get the financing that they need? So unless you're paying cash, and if you are, God bless, you probably don't even need to be on this call. But unless you're paying cash, it will be of utmost importance for you to have that formal pre-approval letter in hand so that you can begin working with a real estate agent and begin making an offer. Again, as it says right here, it spells out very clearly what you will be able to afford. There's no questions. You will have a clear breakdown on what payments will be and what costs will be. A realtor is not really going to want to work with you without having it. It's going to make your negotiations better. So everything in real estate can be negotiable. And having a mortgage pre-approval gives you a considerable amount of leverage in your negotiations with the seller. Meaning, listen, if they have two offers and you're pre-approved and the other guy isn't, they're going to be more apt to take your offer just because that pre-approval carries so much weight. It's going to save you time in the long run, because you've already applied for your mortgage. We've already documented your income and your assets and your credit. Really, all we need to do at that point is analyze the property that you're purchasing. In today's competitive markets, one leg up that you can have as a buyer is to offer to make the process go faster. And having a pre-approval will allow you to do that. You can say to the seller, look, I'm already pre-approved. You see my credit union has approved this type of loan for me. We just need to sign the contract, have an appraisal done, talk about that, and we can close on this deal. So again, a lot of leverage in your negotiations. Finally, of course, there's no cost for this, so we don't charge a fee at the credit union, and there's no commitment. I mean, if nothing works out, unfortunately, then there's no harm, no foul. You've not spent any money. You spent some time maybe looking for a home, and unfortunately, if it didn't work out, you've not lost anything. No obligations to the credit union. So a pre-approval is really, really important. Every real estate agent that you speak with is going to tell you that you must be pre-approved. It's not obligatory on our part, but from your mortgage professional, you really will need to have the pre-approval. So let's move on to the next slide, please. We're going back to this overview of the whole process. You've been pre-qualified, you were pre-approved, you've been doing your home search. And the home search could take anywhere from one weekend, and you might be lucky enough to find a home that first weekend, or it could take 6 months. That will be up to you and where you're buying and how particular you are and how much time you have. But once you have identified the property that you wish to purchase, you will make an offer. Typically it's verbal. There'll be some negotiations back and forth. Your real estate agent will assist you at that point. Once you've agreed on a price, then a contract of sale will be drafted and signed. So the contract of sale is the purchase agreement. It's the legal document that says that the seller is going to sell you the property and that you're going to buy the property under these agreed upon terms. When you sign the contract of sale, bear in mind that you are going to be asked to make what's called an earnest money deposit. It could be called a contract deposit. And that could range in some states or towns in the United States. It could be as little as a few $100s. It could be as much as 10% of the purchase price if you're buying within the 5 boroughs of New York City. So a lot of money is going to be paid out of your pocket up front. Ultimately, that money that you've paid in that earnest money deposit will be credited towards your purchase. But you will pay that money out. That money will be held by the seller's attorney or by the settlement agent until the time of closing. Next in this process, you will want to, oh, sorry, thanks. Not quite. You're going to conduct a home inspection. A home inspection is a very important step. It's technically not part of the mortgage process, but it's really important, especially if you're buying an existing home. You've signed a contract with the seller and you've agreed on everything. You're given a certain amount of time to hire an inspector to go in and visit the property. You've visited the property already, hopefully in person or at least virtually, and you've checked it all out and looked at it, but you're not a professional home inspector. You'll want to hire one to come in and visit the property. What the inspector will do is check all the mechanicals for the property. So that means the roof, the foundation, the electrical system, the plumbing system, the HVAC, heating and ventilation and air conditioning. The inspector is going to review all of that and issue a report for you. Hopefully, there will be very few, maybe minor items that are not really even particularly a concern. There could be other issues in this home inspection that give you pause and that you would want to renegotiate some issues with the seller and ask that the seller either make certain repairs before the closing takes place or credit you money so that you can make those repairs during the purchase or just after the purchase. Or, this could be a best case, worst case scenario. The inspector can come back and say, listen, there are severe problems with this home. There's foundation issues or whatever it may be. And you may decide that you don't want to buy the property at all. So it's worst case in that at that point, you've probably got your heart set on it. But it's best case in that you've found out about these problems now at the beginning of the process. And you might decide to back out of the deal as a result of the home inspection. Now let's go to that next slide, please. So you've done your home inspection and you've signed your contract. You'll continue working with your mortgage team at the credit union on updating any documentation that's necessary. If you are buying a co-op or some condominiums, you would also submit that board package. Remember the package where you submit all the information about your personal desire to buy this apartment, and you go through the board approval process with the apartment building. Your attorney will review the title. Chris is going to talk about what that means a bit later, but ultimately you want to make sure that the seller has the legal right to sell you this property without any types of liens or judgments on it. So this is a very important part of the process. It's sort of behind the scenes, but very important. Ultimately, you'll schedule the closing. And the closing is that day when all of the various parties meet. At least in the old days, it was all done in person. Some of it's done remote now, but you would schedule a closing. The parties meet, the monies change hand, the new deed is signed, the mortgage documents go into effect, and you walk away with the keys. So that's the mortgage closing. That's the end point of this whole exercise. Just before closing, you would do what's called a final walkthrough. So you're given an opportunity, typically the morning of the closing, to go visit the property just to make sure that everything looks good, no changes have been made, all the seller's belongings are out, and it's relatively clean and ready for you to buy it. I said, this is the end point of this whole exercise. Let's talk about how long that exercise takes. Typically, the purchase of a house or a condominium would take, from the time that you've signed the contract to the time of the closing, normally I would say 45 to 60 days. You're probably looking at around 60 days in today's world, just because there's so much mortgage and home buying and home selling activity, but things are jammed up a little bit. There are some parts of the country, Florida, California, generally the West Coast, where faster closings are the expectation or the anticipation. And we will certainly do everything we can to accommodate that. I keep talking about co-ops. We do so many co-op loans in New York. Co-op deals certainly would take longer because you have that board approval process thrown into the middle of it. And you, nor I, nor the seller, nor the real estate agents, nor the attorneys have any control over how long that process may take. You would really count on probably 90, maybe even 120 days to complete the purchase of a co-op apartment. But there we've got start to finish, roughly 60 days. Sounds easy, right? We will walk you through the whole thing. So let's go to the next slide, please. Let's touch on some of those basic mortgage terms that we use. So on the next slide, I mentioned down payments. So we've really already touched on this a bit. Down payments, again, the portion of the purchase price that you're paying out of your own funds. And that ranges anywhere from 5% to 30% of the purchase price. We're also going, so you need to budget. So we've got this slide titled Budgeting for the Purchase. So you need to save for that money because, as I mentioned earlier, the 20% down payment on a $500,000 property is $100,000. That's a lot of money right there. We're going to talk about some lower down payment options a bit later in this presentation. But you also need to budget for the closing fees. So when you're buying real estate anywhere in the US, there are going to be fees involved. As a credit union, as a member-owned organization, we try to keep our fees to a minimum. And compared to other commercial lenders, our fees, the fees that you're paying directly to us for our services, are very, very low. However, there's a lot of other fees that you need to plan for. And fees will vary by state, by city, by county, depends on where you're buying and what you're buying. In some parts of the country, closing fees may be $5,000, $6,000, $7,000, which is still a lot of money. But compared to some parts of the country like New York State and New York City, where closing fees could be another 5% of the purchase price at minimum. So if you're taking out a $500,000 mortgage, you could have $25,000 easily in closing fees. So you might be looking at $100,000 in down payment and $25,000 in closing fees. So you really need to plan ahead. In the first meeting that you have with your mortgage representative and you do that pre-qualification, a very important part of that discussion will be funds that you have available. Because as you can see, down payment becomes one of the biggest concerns, if not obstacles, particularly for a first-time home buyer, just because a lot of cash is going to be required. So we'll talk you through all that. On your own, you can use a really fantastic feature on our website. So you can see the link for it here. It's unfcu.org/calculator. So we have a calculator in the mortgage page that will not only give you current interest rates and calculate the payments for a particular loan amount, but if you put in some more detailed information, the city, county, and state where you wish to buy, the anticipated purchase price, the anticipated loan amount, what you think the property taxes may be, this calculator will generate an entire set of really very closely calculated fees for how much you would have to anticipate for closing fees. It's really amazing, and it's great for someone in the very beginning of the process to go online and say, well, maybe I want to buy in this town, or maybe I want to buy in that state. Let's see what the fees can be, and vary from one place to the next. Just from New York State to New Jersey to Connecticut, right here in the tri-state area around New York, fees vary tremendously, with the highest ones being in New York, and then New Jersey and Connecticut being pretty comparable. So you're budgeting for your down payment and for your closing fees. Let's look at the next slide, please. There's two different types of mortgage loans that are available. We offer mortgages we might offer loans with fixed rate mortgages and with adjustable rate mortgages. So a fixed rate mortgage is exactly what it sounds like. You borrow a certain amount of money from the credit union for anywhere from 10, 15, 20, 30 years. And the interest rate is going to be fixed for the entire term of the loan. There's a tremendous amount of security and safety, really, with a fixed rate mortgage, and that your interest rate and therefore your payment is never going to change. This is a great loan for a member who has a longer horizon of ownership. So someone who wants to raise their family in this particular home, perhaps retire in this home, or just has plans to live in this property or to keep this property for many, many years because of the long-term stability that goes along with that fixed rate mortgage. Rates have been incredibly low for the past 2 years. As Ray had mentioned, interest rate markets are pretty volatile right now, but for the past couple of years, fixed rate mortgages have been very popular just because they were so low, and people decided they would just go ahead and lock into it. But typically, a fixed rate mortgage is going to be a bit higher comparatively than an adjustable rate mortgage. So let's go to the next slide and look at adjustable rate mortgages. These are also called an ARM, which is an adjustable rate mortgage. These are 15 or 30-year loans. But instead of having your interest rate fixed for the entire 15 or 30 years, your interest rate would be fixed for an initial period, say the first 5 years or 7 years or 10 years. The benefit to the adjustable rate mortgage, or the ARM, is that for that initial fixed period, your interest rate is going to be lower than on the fixed rate mortgage. That has a couple of different benefits. One, it can allow you to maximize the amount that you can borrow, because the lower interest rate on that adjustable rate mortgage means lower payments, which means you can borrow more money. And if you're looking to maximize the amount that you borrow, which some people are, then the adjustable rate mortgage can be a great option. Adjustable rate mortgages have traditionally also been very popular with UN staff members. A lot of UN staff members who are buying real estate in the US are not necessarily buying a home that they plan to live in forever. Statistically, our members keep their mortgages for about 6.5 years. And if you are going to be statistically average in that way, why not consider an adjustable rate? You will get a lower interest rate for the period of time that you have the loan, pay less interest to the credit union, have lower monthly payments for the same loan amount as compared to the fixed rate mortgage. Adjustable rate loans are not for everyone. They certainly carry some risk with them. Just by nature of the name, the interest rates are going to be subject to change after the initial fixed period. So after that first 5 years or 10 years or 7 years, the interest rate will begin to adjust. And every year, when the interest rate changes, your payment would change. And if the interest rates are going up, that means your payment would go up. So you need to have some pretty clear ideas about how long you think you might own your home if you really wanted to consider an adjustable rate mortgage. Both are great options. We're happy to give you all the details when you meet for that initial pre-qualification, or as you go through the process, and maybe some of your choices or decisions changes as you look at different property types. Let's go to the next slide, please. Okay, Now I get to put on my salesman's hat. And why would we love for you to consider the credit union? Next slide, please. One, we're your credit union. So as I mentioned, credit unions are member-owned organizations, member-run organizations, and we're the credit union for the UN. So we understand the specifics and the uniqueness of your employment, of your mobility issues, the terminology that's used in your employment practices. One of the more frustrating things for a UN staff person might be sitting down with a commercial bank to talk about a mortgage loan, and the first thing they ask for is your tax returns or your W-2, and they don't understand maybe what a G4 visa is. Well, that's pretty much all we do. We know what a personnel action form is, and post adjustments and child allowances and dependency allowances. We understand the paperwork that comes along with being a UN staff person, and we also understand really the difficulty that goes along for buying a property, in another country. For most of you, this would be a first-time purchase, at least in the United States. And even if you have purchased a property elsewhere, home buying is very different from one country to the next. So we understand that there's a lot of education and time and patience really needed to walk our members through this process. You might be buying a home not only in another country, but in a language that's not your primary language. And so we are here really to give you guidance throughout that entire process. As I mentioned, as a credit union, our rates, fees, our goal is to keep both of those as low as possible. We do, of course, move with the markets, but rates and fees, we try to keep them. That's one of our goals, to make the most flexible and advantageous loans available for our members. Quick item I want to hit on is, we've talked briefly about credit profiles. And a big concern for a lot of UN staff members as they are moving to the US is, what if they don't have a credit score or a US credit profile or a social security number? Credit scores and credit profiles are really one of the primary driving factors for most mortgage lenders in the United States. We understand that a lot of our members don't have a credit profile, and we are not only willing and able to make mortgage loans for someone without a credit profile. We're happy to. We would use alternative documentation to basically document your credit worthiness, because we wouldn't have a credit profile here in the US. So we are very adept at working through this particular issue. We're happy to help you with it. Once you have gone through the process and have bought your home, we're also happy to help you with credit building, because if you're going to be living in the United States and now you own a home, you're probably going to want to have other credit cards, other needs that would benefit from having a strong credit profile, and we can help you in that process too, in terms of building your credit profile. So we hope that, of course, that you would come to your credit union, who's, we've designed our programs really to help benefit you and staff members as best as we possibly can. So let's talk about some of those. I think I need to wrap up. Let's move on to the next slide, and we'll go through a couple of these. The credit union has some great new programs. In dedication to our own efforts at the green movement and global sustainability, we have a new product called a Sustainable Impact Closing Credit. So basically, if you were buying a new home that is Energy Star certified or LEED certified, basically meaning it's met certain environmental standards, we will give you added closing cost credits. And as we mentioned, closing fees add up a lot. So anything that you can get as a credit from the credit union is really very helpful. So we've got this new Sustainable Impact Closing Credit Mortgage. Next slide, please. We have our first time home buyers program. Now, this is a program that was available pre-COVID. When COVID hit, the credit union, like a lot of lenders, really sort of restricted some of our lending options. And one of the things that changed the most was the requirement for down payments. So we bumped up the amount of down payment that would be required. But as we slowly move back to a more normalized period, the credit union has reopened our first-time home buyers program. And you can buy a home in some cases with as little as 3% down payment. I would tell you that a program like this does require that you have some amount of credit or a credit profile in the US. Just because there are different insurances that are required, and these are provided by third-party independent insurance companies, and they would require credit profiles. So anyone who's looking to purchase with no credit profile, let us walk you through some of those steps. Next slide, please. This is the Fannie Mae Home Ready program. This is another program that is sponsored by Fannie Mae, a giant institutional investor in mortgages here in the US. It's designed for someone who maybe doesn't have the same income level that would typically be required for a purchase. It also has some more flexibility on credit requirements or credit profile requirements. Our next slide is FHA loans. So the credit union does offer a couple of loans that are specifically for US citizens or permanent residents. These are loans that are sponsored or created by the US federal government. One is by the Federal Housing Administration. The other is the Veterans Association. So that's for United States veterans from the armed services. We do offer these types of loans, but those are limited to US citizens and permanent residents. Okay, I'm trying to speed on to our next slide. Sorry to rush you. Quickly, hey, if you are part of the Member Loyalty Rewards Program, your mortgage counts towards your minimum overall balance. So typically you meet these minimum balances by having funds on deposit at the credit union, but your mortgage counts toward that too. So listen, you take out a mortgage and you're basically automatically in a gold level, if not a platinum level, which gives you some very nice breaks on fees and savings from the credit union. So my next and last slide, please make an appointment with a mortgage representative. That initial contact with your mortgage rep is so important. You're going to get a lot of information out of it. Go online, schedule an appointment. We're available in person if you're here local, or of course online via Zoom, whatever works for you. And we look forward so much to speaking with you, and good luck with your home buying. Thank you so much for your time today. I'm going to see you again later in the symposium, but we really do appreciate you joining us today, and all the best. Thank you.
Thank you, Chip. That was a wealth of information. Thank you for sharing all of your expertise and knowledge with us today. We do have a series of questions. I mean, they are just coming in very quickly. So in no particular order, I'm going to select a few if you would be so delightful in being able to answer those for us. I did like one of the things that you had said as far as we need to create a team, and we're here to help our members do that, that being a mortgage rep, which we will be putting a link in the chat later to go ahead and start that appointment process to get a pre-approval, the real estate agent and the real estate attorney. Now, in your first couple of slides that you were discussing the different types of properties. So a member would like for us to clarify the meaning of 1 to 4 family. Is this the number of people or the actual number of families?
Well, very good question. Thank you. The terminology that is used is 1 to 4 family, but it actually more technically should say 1 to 4 units. So each unit in this jargon, in this terminology, is deemed to be each family. So if you have a property that has 3 units in it, so it's let's say a 3-floor building, each floor is a separate apartment, and each of those apartments is a unit that can be occupied by a tenant, whether that's a person or a family or roommates. Really, a better term for this property would be a 3-unit property. It is commonly or colloquially called a 3-family property. So, or a 1, 2, 3, or 4-family property. So I hope that helps clarify, and very good question. Thank you.
I think it totally does now that the verbiage is clarified with units. So now, those types that you referred to, what about if a member is looking to finance a lot or construction loan?
Very good question. Unfortunately, the credit union does not offer construction financing. I wish that we did, but it is difficult to do on a national basis. We lend in all 50 states, and when construction is being financed, then the lender needs to make site visits periodically throughout the construction of the loan. And we simply don't have the staff. I mean, believe me, I would volunteer if we were doing construction loans in Southern California, but we don't. We don't have the ability to go out and do those types of site visits. Typically, construction loans are offered by a local bank is who normally offers construction financing. So unfortunately, we do not offer construction loans here in the United States.
Okay. I would definitely volunteer myself, but not necessarily in any, warmer climates. I like to go up north into the mountains.
Okay. Whatever you prefer.
But, yes, thank you. So here's another one. It's kind of twofold. So how long does the pre-qualification and or pre-approval process that you spoke of usually take at UNFCU? And then once it's received, how long is it valid for?
Great question. I wish I should have covered that when I was discussing them. So a pre-qualification, I mean, listen, we can give you a pre-qualification certificate that basically says that you've spoken to a lender and that this type of loan should work for you. There's not really an expiration date on that because we have not documented any income or credit and so forth. And the pre-qualification itself will be done, within the first hour-long appointment that you have with your mortgage representative. The pre-approval is very different. Again, with the pre-approval, since you are submitting pay statements, your personnel action form or W-2, if you're in the US, bank statements, we would obtain a credit report. Whether there's any information out there or not, we would be obtaining a credit report. And all of those items are good only for a certain amount of time, which is 120 days, basically 4 months. So once you've applied for the pre-approval, I mean, that can be done quickly. When you apply for the pre-approval, you'd have it within a couple of days. Once the pre-approval is issued, it's issued for 4 months or 120 days. If, unfortunately, you don't find a property within that time frame, we can always extend it depending. Look, if you only need it extended for a couple of days, we'll be happy to do that. If you need a lengthier extension, another 4 months, then we would update your income and asset documents. We would run a new credit report, and we would issue you a new pre-approval letter. Still no charges, no fees for doing that. And unfortunately, it happens. It can take a while to find a property.
Excellent. Well, that's good to know that the process can be redone. So it looks like that's the time that we have for questions. But Chip, I know we're bringing you back later in today's session, so we will tackle a couple of more of these questions that we have coming in.